Awesome. Well, real quick, I guess just some housekeeping. These webinars are for you. So if you have questions, as Bob and I are going through the slides, put your questions in the Q&A at the bottom. Ryan's on board. He will make sure that we cover all those questions, get answers for you. And if for some reason we don't cover those this evening, then we will certainly make sure to follow up with you directly. Okay, so with that, we'll jump kind of right in. Welcome, everybody. I know everyone has busy evening, so really appreciate your time joining us today. Why Bob and I kind of break down the One Big Beautiful Bill Act. Sometimes you've maybe have heard it called OBBBA, OB3. We've kind of heard it all, but today we'll kind of really hone in. It's a big bill, so we'll focus on some of the major items in this act that will directly impact our clients the most, and those items that we've had a lot of conversations around and a lot of questions. So as you can kind of see here, this is kind of what we'll go through. Now, I will say with the One Big Beautiful Act, just to kind of get an overview of it, it was signed into a law on July 4th of this year. And so there's a lot of components to it. We'll kind of dive in, highlight some of these right here. It was really a culmination of a lot of the tax planning strategies in the TCGA. And Bob and I will try not to throw a bunch of acronyms at you tonight, but so it was kind of a culmination of that. That was passed in 2017. That really was supposed to sunset this year. So the OBBBA really provides clarification. It extends some of those provisions. It adds some new ones. It also makes some temporary revisions to those. So that's what we'll go through today. Bob will kind of walk us through a lot of these components. You might not see a huge amount of changes as, a tax filer, but certainly change nonetheless. So we want to make sure that we clarify some of those. We will really spend a chunk of time going into the deductions and exemptions, especially for our clients that are 65 and older, on this webinar tonight, and how that impacts Social Security. And then we're going to kind of wrap everything up, focusing on the Trump accounts. There's been a lot of questions, a lot of commentary about that. So we'll clear the air on all of those, really focusing on our clients that, one, are thinking about starting a family, maybe have young kids, or even those that have grandkids and just want to learn more about it. So with that, I'll kick it off to Bob.
All right, perfect. Thank you, Nora. Appreciate everybody being on here. And as Nora mentioned, please, we encourage questions. Even the slides that we have here this evening, if I just went straight through them, it'd take us about 12 minutes to finish the webinar. So we encourage questions, shoot them out there whenever, and Ryan will kick them over to us when we see them. So, and I see someone's raising their hand. If you can put it in the chat box or whatever, you can go ahead and do that. But good to see everybody tonight. So I'm just going to go ahead and kick it off with the first slide. So the big thing was that starting in 2026, going back to what Nora mentioned, the Tax Cut and Jobs Act, right, that Trump had in place, in 2026, all of the tax rates were supposed to go back up to the prior rates that were there. I think it's the Bush era tax cuts. And with this One Big Beautiful Bill, which I'm probably not going to say that a ton because it's just such a mouthful. But anyways, the marginal tax rates are staying where they are currently and where they have been for the last 8 years for, it's permanent until some other administration changes it. So our marginal tax rates are going to be 10, 12, 22, 24, so on and so forth. Whereas if it would have sunset, those would have all jumped up to 12, 15, 25, 28. I think all the Bush era tax cuts. And the nice thing about this is it extends the runway for a lot of us. I know that we were doing a lot of Roth conversions with clients, getting ready for the rates to go back up in 2026. And this extends the runway for us to get these lower rates at the lower marginal tax bracket. So that's kind of the big first step with the extension of the One Big Beautiful Bill. They also, and you could see, we kind of compare them here, but you could see they slightly raised some of the brackets. There's small little changes like that. And beyond that, though, they also did the same thing to the standard deduction. So back, when I first started in this industry, it was a lot more interesting doing some of the tax planning and much more important to itemize your deductions, because the standard deduction was significantly lower. And with the passing of the One Big Beautiful Bill, the married filing jointly, standard deduction goes up to 31,500. And this is just for anybody. There's a lot of other nuance that comes from if you're, over 65, we'll talk about the senior thing, all that. But generally, the standard deduction has been increased. And the reason behind this is the federal government is trying to say, it's simpler for us to just have a bigger standard deduction versus trying to go through all the nuance of how to take advantage of the itemized deductions. So they want to try to simplify. And so increasing the standard deduction is something that is put in place and will be permanent, of course, until it changes. So,
Yeah, and Bob, just to
um,
add here, this will start in the 2025 tax filing year. And a quirky thing to note, and of course it's going to be a little bit more complicated, but with so many updates, changes, extensions, permanent, temporary, they don't all happen in 2025. So when we go through these, we'll try to provide as much transparency on when to expect these changes. Some happen in 2025, others 2026, and some we've even seen go through 2027. So this specifically will be starting at the 2025 tax filing.
yes, thank you, Nora. That's a great point. In case I forget to say that, like the charitable deduction change starts in 2026 versus starting here in 2025. So that's a great point. And we'll try our best to navigate some of that, but just a really good thing to keep in mind and keep note of. So um, the other big change from a deduction perspective was what they call the SALT deduction, and that's state and local taxes, which also includes our property taxes. So, for those of you who either have really high or feel that you have high property taxes, which Nick Gukin and I were talking today, that's his least favorite tax that is out there, right? But if you have high property taxes or you live in a high income tax state like New York or California, this piece can become very important. So just a little graphic right here. Prior to the OBBB, that's easier for me to say, so I'm going to go with that, Nora. Thank you. You can see that it was limited to $10,000 per year for your SALT deduction, and with the updated rules, that goes up to $40,000 for the next, I think it's 5 years. So this is taking effect this year. You can see it here. And so if you do either have high property taxes or live in a high income tax state or local tax area, this is going to be beneficial for you to be able to potentially itemize your deductions versus taking the standard. Okay. And then, of course, again, if there's questions, Ryan, just jump in and stop me. Nora, jump in and stop me. This is just a quick illustration of how the SALT deduction is going to work, and especially is important if you happen to fall into the higher adjusted gross income area. So we can see this green line here. This is what we're talking about. Just going back a slide. This is the $40,000 for the SALT deduction. We can see that it's up here at $40,000 if you're making 250, 300, so on and so forth. But if you start crossing into, over $500,000, it starts to deplete and effectively goes back to the same level that it was at prior to this bill being changed. So, for those of you that may be in the higher income areas, this may not be as beneficial. But certainly for anybody that's below that 500,000 of adjusted gross income, the SALT deduction is going to be a nice change and a nice benefit for you.
Yeah, and this cap is supposed to revert back to the 10,000 in 2030. So again, just some things that, as we get in towards that planning, will probably come quicker than we think. Things to consider when you're thinking about, filing your taxes and what deductions you can take.
Yep, absolutely. So, and you know, not this is another one that was a big change. So overtime and tips are going to be exempt from tax. And so this is only going to be for a few years. So it starts in this year and it goes through 2028 tax years, right? So we've got what, 4 years for this to be in place. And while it is nice that tipped workers are going to be able to exempt some of their income, and same with overtime, an important thing to note, and you can read through the slide here and everything, I won't just read it to you, but a couple important things to note is it's capped, right? 25,000 on an annual basis. And also, it's only exempt from federal income tax. Okay, so it is not exempt from state taxes, from local taxes, from Medicare and Social Security tax. All of those are still going to apply to tips and to overtime. But for the next few years, there is going to be a nice exemption on overtime and tips for those that depend on those from an income perspective. Okay. And so the next one I want to get into is really the one that we've gotten the most questions about and the impacts a large majority of our clients. And now I took this screenshot from you could see the Ways and Means Committee, right? The House, whatever. This is a government website that says no tax on Social Security, 63 billion in tax relief for American seniors. This is an extremely misleading headline. It makes us think that Social Security is no longer going to be taxed, and I'll talk through why that is not the case. But in reality, they did create some additional deductions to our income or to tax filers' income that helps offset Social Security tax and just overall income for those that are in retirement. So if any of you read a headline that says there's no tax on Social Security, please disregard. It is not true. It is a over exaggeration of how it works. So the way it actually works is just as an additional deduction when it comes to filing your taxes. And, I think these charts are great, but in a second, I'm going to walk through an example so we can kind of actually see how it works and how it's going to tie in. But it's really just layering on top of the standard deduction. So I'm just going to skip over here to the one on the right because, for a lot of our folks that we're working with, they're married, filing jointly, getting Social Security, all that stuff. So the way it works is you get your standard deduction, the 31,500 that we talked about. Also, there's an additional deduction already built into the tax code for any folks that are over the age of 65 that you get an extra 1,600 per individual. So that takes it up another 3,200. And then what happens is the additional senior deduction comes in and layers in on top, and that gives us an extra 12,000 of a tax deduction for your taxes, and this will start in 2025. So this is one of them that will start in 25. So any of you that are watching this here that are over 65 years old, whether you are taking Social Security or not, this senior deduction will be available to you. So just again, it's another thing that I want to make very clear. This deduction does not tie into Social Security directly. It is just an additional deduction for those that are over the age of 65. Okay. So saw something come in. Do we have a question on that one there, Ryan?
Yeah, based on age, not whether or not you are getting Social Security, was the comment.
Yes, that is correct. So just to verify that and make sure we're on the same page, if you are over 65, regardless if you are taking Social Security or not, you are eligible for the additional senior deduction. Okay. So what I would love to do is just go through a little example here. So I'm going to talk a lot and I might talk quickly. So please just, let me know if you want me to go through things again or whatever. But one of the things we have here at Balance is some really nice tax projection software. I will not call it tax planning software. We're not CPAs. We're not, enrolled agents, anything like that. We can help give tax guidance, but just understand, we're just trying to help. But I have this great software that helps me work with folks to understand where their taxes are going to fall on an annual basis. So this is just a little breakdown. So this is prior to the OBBB being passed. And let's just say we have a husband and wife, both over 65, mostly IRA distributions and Social Security. What we see, so qualified dividends, that can be just dividends, interest, capital gains, whatever it may be. They have about 5,000, right? They might have a high yield savings. They might have a small brokerage account, whatever it might be. IRA distributions, about 65,000. Their Social Security between the two of them, about 55. Taxable Social Security in this case, though, is 85% of your gross Social Security, which is only 46,750. That all rolls down to about 116 in income. The old standard deduction for two folks being over the age of 65 was 33,200. That put your taxable income at 83,550. And based on our marginal brackets, you'd pay about $8,900 in federal income tax. This is not tying in state or anything like that. The software does do that, and I'm happy to walk through that with anybody, but that's just kind of the baseline. With the change, we're going to have the same exact situation from an income perspective. Same dividends, interest, capital gains, same IRA distribution, same Social Security. You could see the taxable amount of Social Security is exactly the same. The difference happens down here. You have a slightly higher standard deduction, and you have a $12,000 additional senior deduction that will play in on your 1040. What that means ultimately is you pay about $1,600 less in federal income tax in this situation, which, based on the tax dollar amount is what, 15-ish, 18% reduction in tax. And that's great. That's awesome. So that is how the senior deduction works. The unfortunate thing is it starts to phase out once your adjusted gross income gets over $150,000. Okay. So this is something that Nora, I know, we talked about a little bit, just like tax planning and stuff. Like, the more we stay focused on this and run it through, whether it's, our tax planning software here, or just by CPA or whatever, we can understand how we take advantage of this senior deduction. So just taking it a step further, I'm going to do the same exact thing for somebody that has a slightly higher total income. Okay, so what I did, same thing, husband and wife, both over 65, IRAs and Social Security, plus an extra 50,000 of dividends, interest, capital gains, whatever it is, right? I'm just adding some income, and their IRA distributions are a little bit higher. In this case, we kind of go through the same scenario. Taxable Social Security is the same, total income, all this, this is prior to the OBBBA. Total tax was about 28,559. What we see in the updated one, so this column again is with the current and updated laws, is that all of a sudden, yes, they have a slightly higher standard deduction, but their senior deduction has been reduced all the way down to about $2,800. So the net impact for somebody that has a slightly higher income is only about $900. And percentage-wise, a much smaller reduction in tax, but still a reduction there. So again, this senior deduction is not something that doesn't make Social Security taxable. It only is an additional deduction for those over the age of 65. So Nora, I know I went quickly through that. Is there anything I missed or anything you want to add from a numbers or how it works perspective?
No, I think if anyone on here that has specific questions, we are happy to walk through your specific situation and just see what numbers and what projections we can come for you. So certainly if you have specific questions, just let us know.
Yep, absolutely. And yeah, just to reiterate that, so thank you, Nora. This is something, this software here, I just built a, I don't want to call it a dummy client, right? Like just a example client in here, right? But we can put your exact IRA distribution, Social Security, whatever it may be, into this software and help you understand how it impacts you. Okay. So again, if there's questions on the enhanced senior deduction, please feel free to fill in and ask, but that's effectively how it works. The next big one is, and not a big one, but the next one that I think impacts a lot of people is an update to charitable deductions. So I'll do my best to be quick about this, but over the past few years, because of the increased standard deduction, if you were donating to charities, whether you give to your church or you supported St. Jude or you gave to, breast cancer research or whatever it was, right? If you didn't itemize your deductions, effectively, you got no income tax benefit for those charitable contributions. And now I'll be the first to say, I don't give to charity. I hope that nobody gives to charity just for the tax benefit. But the fact that you haven't gotten any tax benefit it's unfortunate, right? So the updated Big Beautiful Bill will allow a small deduction for non-itemizers. This is one of them that Nora, I'm reminding myself, right, does not start until 2026. So this does not apply to the 2025 tax year. But basically, if you make charitable donations up to 2,000 for joint filers or 1,000 for single filers, you will be able to deduct this from your income, even if you just take the standard deduction. So this is a really nice additional benefit that for those of you that give, 500, 1,000, even $5,000 a year to some charitable organization and you haven't been able to deduct, now we will be able to deduct up to $2,000 per year per joint filers. Okay. These need to be cash contributions to public charities. And I know a number of our clients have donor advised funds. These cannot be donor advised funds contributions. They have to go directly to the charity. So this is one that, and there's a lot of other changes to charitable deductions. We're not going to go into those this evening because I think it doesn't apply to enough folks. But this one I think is a really exciting one that offers some additional tax benefit for those contributions that you make.
Yeah, and I think, Bob, so we talked about, I don't want, again, not to go into too much detail, but we talked about the non-itemizer, so the standard deduction. For those that do itemize your taxes, and again, this is more of just kind of a FYI, when you do file your taxes and you have questions with your CPA about it, there is a 0.5% floor for those that do itemize their taxes. So you have to contribute more than 0.5% of your AGI in order to deduct that amount. So that's kind of like the starting point. So again, it certainly doesn't affect a lot of people. Definitely want to note the non-itemizer, the benefit there, but just to kind of keep in mind, if you do itemize, there is a floor to that to start off.
Yes. And that's a great point, Nora. And I think where the planning comes in for that one is if there's any folks that are listening or watching this, and this doesn't take effect until 2026. If you were thinking about making a large charitable contribution in the short run, so in the next couple of years, it may make sense to accelerate that into 2025 so you don't have that sort of floor of the 0.5% of adjusted gross income. So things to keep in mind, things to keep an eye on. Great point to bring up, Nora. Thank you for sharing that one. Okay. So with all this, again, we use a software called Holistiplan, and this is something that folks that have worked with me, you have seen these over the past year or two. For the folks that have come in through, working with Sean and Nora, Dave, the rest of the team there over at Bolt, you may not have seen these yet. But these are reports that we can run for you guys that really just helps to add some additional color and context to your financial or your tax situation. And these are just a few screenshots of the type of report that it spits out for us, right? It helps us understand our adjusted gross income, our taxable income, our average tax rate. It gives us an idea where we fall from a marginal rate perspective and how much room we might have for Roth conversions or other planning ideas. It also gives us an idea for where our Medicare premiums may be looking forward 2 years, which is an important planning topic. And it also helps us understand where we might fall for different kind of under or above different deductions, right? So we talked about the SALT deduction cap, right? Sam and Betty client are well under it, but they're above the savers credit, right? So if anybody on this call, anybody watching it, if you're interested in seeing some reports like this, please let us know. We'll work together as a team to put these into place and help give you some guidance from a tax perspective. All right. And so I'm going to finish up some of the deductions and kind of the OBBB and how it worked there. And I'm going to hand it off to Nora to take over to kind of take us home through the Trump accounts and that. But again, if you have any questions on what we already went over, or if you have any questions going forward, please drop them in the chat. We're happy to stop and answer them and go from there. So Nora, I'm going to hand it over to you to go through the Trump accounts.
Bob. So we've received a lot of questions about the Trump accounts. What are they? What does this mean? Do I qualify? Who qualifies? And so similar to kind of what's been going on with Social Security, there's a lot of misinformation on there. There's a lot of information that speculative information on what these accounts mean in the regulations around those before the OBBB was actually approved. And so I'm just going to go through everything we know up to this point. And that's kind of a caveat that, there's still things that need to be determined. So I'll kind of go through those. And again, if you have more questions, as more information comes out, we're happy to relay that to you. So the first kind of question is, what are the Trump accounts? So Trump accounts are really modeled off of a traditional IRA. And so you'll see some of that tax deferred or tax delayed growth in those type of accounts. Now, they do come with some unique rules. And one of the things that was incorporated in the OBBB was that they said you can't start contributing to a Trump account until 12 consecutive months. From when the act was approved or into law. And so you technically cannot start contributing to a Trump account until July 4th of 2026. So again, another kind of quirky date to keep in mind, but you can't open accounts and you can't even contribute to those until next year. And, when I think of that, it's me saying, okay, well, the custodians, the IRS, the federal government need time to determine how to set up these accounts, who's going to be able to provide these, what kind of paperwork do they need to file to the IRS to account for some of these unique tax consequences. So all of that is kind of still to be determined. One good thing, I think, overarching this with the Trump account, it is kind of like a nest egg for children to start their retirement. Hopefully it generates some more financial literacy. I think that would be a huge improvement that we have. So I do think there are some good things that come with this. So when you kind of go into what a Trump account, let's talk about who qualifies for that.
Oh.
So anyone that is 18 and younger can open a Trump account when they're available with a Social Security number. So Bob, if you want to hit to the next slide, I'll kind of clarify, and it's easy kind of look at, the Trump account two separate ways. One, what are the rules and regulations to those beneficiaries that are 18 and under, and what happens to a Trump account when the beneficiary turns 18? So as you can kind of go here, there's certain contribution limits in who can contribute to these. So, there's a max contribution of $5,000 into a Trump account. This can come from a guardian, a parent, a grandparent can contribute to this up to a max of $5,000. And note that these are non-deductible. So when we look at some of the other vehicles or different, planning options, when we look at children and funding futures for them, a Trump account is not like a 529. For most states, you get a tax deduction. For the Trump account, there you will not get a tax deduction for any contribution. So that's something to kind of consider when we talk about planning. There are some additional contributions that can be made. Employers can make contributions into these accounts. Now, that obviously depends on what employee benefits they provide, but employers can offer this for a $2,500 max per year, and this will go towards that $5,000 max that you are able to contribute. Governments, charities can contribute. Again, there's a ceiling to that of $2,500, and those contributions do not go towards the $5,000. So a little unique there. What can you invest in? And so, they put some stipulations on this as well. You can't invest in anything you want. There are some specific requirements, those being low cost. So they did put a 0.1% annual account fee on this. That's the max that you can be charged for this type of account, and you have to invest in mutual funds or ETFs that follow a specific index. So that would be like the S&P 500 or something similar to that. So limited investment options here. You are not allowed to take any distributions prior to 18 into this account. There was some news floating around that you can take it distributions penalty free for education or small business loans. That was prior to the OBBB actually being approved. So just some clarification there. You can roll over a Trump account to another Trump account for the same beneficiary. So there's no penalties for that. I don't see that happening too often. But another key thing to hear is that you can make contributions into other IRAs. So we say that it's set up like a traditional IRA, but it's almost its separate type of IRA because you can still contribute to another IRA. So for example, if you have a child that's 15, you contributed to, a Trump account, an IRA for them, and let's say they have earned income, you can also contribute to like a contributory Roth IRA for them as well. And those amounts, those maxes are completely separate. So you can do 7,000 in a Roth IRA, 5,000 max in a Trump account. So those are separate. Now that changes when the beneficiary turns 18. So when they turn 18, that becomes a traditional IRA and it's treated as such. Now, whether this automatically happens or you have to roll it into an IRA, that's still to be determined. But it will act like an IRA. Your investment options will open. There will be early withdrawal penalties. Potentially, most likely, there'll be RMD requirements. You can take withdrawals after 59 and a half. So we'll act similar to a traditional IRA. Again, most of the commentary around this is that it will not aggregate with other IRAs in their distribution rules. So this comes into play if, for example, your child, grows up, past 18, makes a certain amount of income and is required to do a backdoor Roth IRA. As of right now, it won't be subject to that pro rata rule, but if that changes, that'll be a very key, important part into your planning in order to contribute to a backdoor Roth IRA. So those are things that we'll continue to monitor. Like I said, we'll play most of the rules into an IRA once they're 18. So Bob, I'll have you kind of go back to the next slide.
Yep.
So that's kind of generally, I know that was a lot of information, but key things about a Trump account. Now, I've gotten a lot of questions about, Nora, what is this pilot program? Do I qualify? Myself, Nick on the team, we had a child both in 2025. And I also unfortunately had a client that had a child on December, I think it was December 30th of 2024. So a key thing to know about the Trump accounts, like I said, you have to be under 18. But for this pilot program, you have to have had a child between January 1st of 2025 and December 31st of 2028 in order to qualify for this pilot program. And it is a seed money $1,000 automatic contribution into a Trump account. Now, whether this automatically happens or you have to apply for that again is still to be kind of fine-tuned out. But that is something to consider. When people think about, should I take advantage of the Trump account? It's hard for me to say no. It's hard for me to imagine anyone saying no to free money. So I think there is a benefit if you qualify for that pilot program to obviously take advantage of it. We go into, are there tax benefits? Like I said earlier, there are no tax deductions when you make a contribution, and the way that this account will be taxed again is similar to a IRA. So those non-deductible contributions will be tax-free if you take withdrawals after 59 and a half, but you will pay taxes on all that growth and those contributions that haven't been taxed yet. So that's something to think about. Again, like I said, should you take advantage of it? If you qualify for the pilot program, if your employer is providing annual contributions or you get, contributions from a charity or the government, that's free money. I would, say take advantage of it. But when we think about planning and what's best for your your specific financial situation, your children, there are other avenues to consider with better tax advantages towards them. Like I said, 529 accounts, depending on the state you live, brokerage accounts that open up your investment options that don't put kind of all those restrictions and penalties on withdrawals. So if you have questions on that, Bob, myself, our team's here to answer those for your specific situation. But I would say take advantage of the free money and then call us for the next best strategy for you.
Yeah. Well, and I'll just add there, Nora, right? And Nora brought it up and just quickly went through it, but Nora had a baby this year. Nick Gookin, our CIO, had a baby this year. If you have had a baby this year, or your family or grandkids, if you welcomed a new grandkid or you're expecting new ones here in the coming years, Certainly taking advantage of the free money is very similar to the 401k match, right? Like there's no reason to not take advantage of it. But know and understand there is going to be nuance. There is going to be some back and forth with it. We will certainly keep you all updated on this as we learn more. But Nora, that was a great overview. Fantastic to help us just understand better what Trump accounts are. And quite honestly, I learned from as you were talking more than I knew. So thank you for all that. So anything else from Trump accounts or any questions or anything out there, Ryan, that we need to address? No?
No, nothing else has come
Okay.
in.
All right. Well, honestly, as I mentioned, if we didn't have questions and everything, well, we talked a bit more than maybe I thought we would have, right? But that's everything we have for the OBBB update for y'all this evening. Again, I'm going to put this disclaimer up here for a disclosure up here for a bit because, we got to do this stuff. But we are here for your questions both this evening and on a going forward basis. If anybody would like to dive into some tax projections or some tax planning with the softwares that we have, you can reach out to your advisor. So whether that's Tyler or Nick or Adam or Nora or Sean or me or whoever it is, Tim on the team, reach out, just say, hey, I'd love to dive a little bit deeper into tax planning because we love to do this stuff. And we want to be here for you and make sure that you get all your questions answered, that you feel comfortable with where you are from a tax perspective, and that you understand how these sorts of legislation changes impact you and your family directly. Okay. Did we get it something, a question come up or just a comment? I saw something pop up.
You guys just got a great job.
All right. All right. So we appreciate that very much. Nora did a great job. Ryan, thank you for being our MC here this evening and making sure the tech and everything works out. Nora, do you have any closing remarks or closing comments or thoughts as we wrap it up here this evening?
No, it looks like everyone's kind of still hanging on. So hopefully someone's just scared to write that question in. But since you guys are here, these webinars are for you. We do them monthly. So if there's a specific topic, we try to make them timely and valuable for you, especially you taking your time out in the evening. Send those to us. Let us know what we can help with or educate you with about what's kind of going on. So we're open to your feedback as well for that.
Yes, we absolutely love it. We have not picked this topic yet for September. So if somebody has something they want to throw out there and thinks it's a good hot topic, we're happy to dive into it. And as always, we will send this out as a recording. We have all of these webinars recorded and on our website, balancewealth.com. Go to the media tab. They will always be there for you. In addition to that, I'm just going to throw a shout out. We are starting a show. If there's any sports fans in the audience, it's based off of Around the Horn on ESPN that just finished up after like 20 years or something like that. But just a real quick show that walks through some of our thoughts, some financial planning topics, ties it into sports, all that fun stuff that we love. So keep an eye out for that as we keep building that. But Nora, thank you so much for emceeing it or kicking this off and going through the Trump accounts. Ryan, thanks for being here on the technology side. And to everybody that was a part of this, thanks for being on here this evening. And we look forward to seeing you next month at our next webinar.